Stop watching Fox or CNN or whatever you watch where they fake news.
Hi guys, my name is Keith Larson and I'm a reporter with The Real Deal and you're here with TRD Talks. Today we'll be talking about what's happening in the CMBS world, also known as commercial mortgage-backed securities. I'm here with Rob Verrone, who's the principal owner of Hound, Debra Morgan, who's the CEO of BlackEagle Real Estate Partners, and Brian Olasov, who's with Carlton and is their executive director, financial services consulting. And so for those unaware, CMBS is a type of debt that provides cheap financing for hotel, retail, office property owners. And it's different than a traditional loan in that it often combines multiple loans together and securitizes them and sells them off to investors. The drawback is that it often has strict rules on modifying those loans when they end up in trouble, and they end up in a process called special servicing, where a lot of them are now. And so today, it's about over $1 trillion dollar market for CMBS securities. And a lot of hotel and retail property owners are now seeing their loans in special servicing and trying to figure out what to do. So I'm here with 3 experts in the field trying to figure out what the next steps are. And so maybe, Rob, if you want to start off, how are special servicers handling these requests from borrowers? What are you hearing, and what are you kind of seeing?
Again, I think it's I think you got to kind of divide the requests. There's patient is sick, has a cold, needs some time to recover, and then there's patient is really sick, needs open heart surgery. I think the open heart surgery, the loans that were in distress before COVID or that really went into distress through COVID, those are being handled as a specially serviced loan, and it's going through the process, which I would say takes anywhere from 6 to 12 months to get done. I think the special servicers are doing the best they can in the circumstance on the less sick loans and trying to give relief where they can, as long as the sponsors understand that, debt is debt and equity is equity, which I've said a number of times. And they're not just handing out forbearances. Things are getting done a lot quicker than they would have gotten done pre-COVID, but still a process, still takes time.
And to Rob's point on that, I think that one of the things that the servicers were able to do early on was come up with a way to address forbearance needs while at the master servicer and not result in a full transfer to special servicing. And I think that helped the process some for a lot of people and allowed them to get through, their initial forbearance, which I know we're seeing start to lapse now, but at least got through the first 90 to 120 days.
Right. Brian, what are you seeing right now?
Keith, I would say we're still in a process of discovery right now. So if you rolled the clock all the way back to March, when the servicers were just starting to get these requests for relief in, the world in mid-March looked very, very different than it did right now. So there was so little clarity back in March about the longevity, the duration of this problem. The majority of special servicers and master servicers were willing to at least strongly consider a 90-day forbearance of payment deferral for 90 days. Nobody believed at the time that that was a solution. It was a bridge to additional clarity, so that if you provided April, May, June payment deferral, hopefully July 1 rolls around, the world would be clear. COVID would be on the downstroke, which a lot of epidemiologists thought at the time. And what they didn't take into consideration is, first of all, nobody on the call, to my knowledge, is an epidemiologist. These are not real estate issues. There were very, very few problem loans going into the pandemic. I think the special servicing rate going into March was about 1.8%. Now it's about 10.3%. And depending on what kind of property type, you can be at 25% delinquency, like some lodging types, which has been particularly impacted. But what the servicer and community is meant to do is to resolve something and to resolve it durably. And it's very, very difficult to resolve something durably when you have no idea about what the world and that property is going to be doing 3 or 6 months down the road.
Gotcha. So what's going to happen? I mean, I know that it's hard to project anything, but we kind of talked before this about, well, maybe the worst is yet to come. And I mean, how many properties that are in special servicing are going to go to foreclosure? Are we going to see a wave of foreclosures now? And what are you guys kind of projecting in terms of what's going to happen to all these properties that are in special servicing now? Rob, do you want to begin?
Some will live, some will die. I mean, some will, you can't say that if you're a borrower in 08, you had 20 properties and 4 of them were in trouble and you kind of figured out how to solve it. If you're a hotel operator now and you have 20 properties, 20 are in trouble. And unfortunately, you just probably don't have enough cash to save them all, because anything you do with a special servicer requires money, and you got to pick which ones you want to save. So there will be REO, there will be note sales, and there will be workouts.
Well, which ones are gonna die? Is that going to be I mean, is there any trends you're seeing? Is it the hotel properties? Is it the single asset, single borrower property? Like, what is it? What are the ones that are going to die? Is it just dependent?
Hotel and retail, and a lot of them.
Yeah.
You know.
Don't you think, yeah, definitely hotel and retail, but also don't you think sometime next year and then the year after that, we'll start seeing the office leasing affect the office real estate market? I mean, despite that, you know, we've had some big headline leasing stories lately, I think in general, we'll see the office market impacted probably in the next year or two.
Are you hearing now?
I don't think there's any question about that. In fact, just to pick up on what Bob was talking about, the difference between the loans that are going to live versus the loans that are going to die is a diagnosis between a liquidity problem and a solvency problem.
Right.
If in fact the problems are transitory, and if we get a vaccine that's widely distributed and that happens tomorrow, then obviously there are going to be many, many more properties that live. But at a certain point, a liquidity problem becomes a solvency problem when the sponsor simply can't dig any deeper into their pockets. And a lot of these trends are not transitory trends. A lot of the trends were in place beforehand. Obviously, the cliched trend that everyone has been seeing for years and years, and the real deal has covered the retail apocalypse along with the rest of the financial reporting industry.
Sure.
But there was a very interesting study by McKinsey and Company that said that the already in place move from bricks and mortar to e-commerce in the last 3 months, it actually encapsulated 10 years worth of trend. So a 10-year trend towards e-commerce was all compressed into a 3-month period of time. That's going to have long-term ramifications regardless of when we have a vaccine and the pandemic is under control about retail, and similarly with office.
Right.
One thing that has worked very well has been work from home. The technology has actually worked, and employers are learning their lesson, and everyone is looking at their leasing costs.
But there's no one who wants to, there's a small percentage. I would take the other side of that bet all day long. There's a small percentage of people that want to just sit home all day with their kids running around and their husband and their wives. Like, I'm a huge fan of New York City. I want to get back to the city. I want to leave my house in the morning, come back at night. And I think that's the majority of people, especially the motivated, focused people you want working for you. Like, no one.
Bob, fortunately, Debra and I are both in very happy marriages.
It's still, you're out in the city.
I guess wrapping that into CMBS with Debra, to your point, have you seen any office properties head into special servicing? I mean, I've been reporting on this pretty regularly. I'm seeing a lot of retail, hotel. Have you seen office properties head to special servicing? And then what is the conversation different between the servicers and those borrowers?
No, so on the office side right now, the stuff that we've seen move into special servicing is more of a sponsor issue than a cash flow issue with the real estate. It's more just the operator has not executed the business plan and therefore it's going into special servicing. It's not like we're seeing a lot of leasing turnover now, and therefore rents getting adjusted or things like that. So that's not happening, and that's why I see that out in a couple of years. And I know, you know, and do agree that there are a lot of people that want to get back to the office, but you know, it doesn't matter. You could still have shift work and that you're in the office 3 days a week. It's hoteling. I just don't know that we're going to be full force all the way back in, you know, on stacked up against each other like a lot of offices were, with a lot of, you know, people moving around. I think it'll be a while. And then to the point though on the foreclosures, I think what we're seeing right now is not the actual foreclosure, but a lot of sponsors giving the servicers the keys, if you will, and just quietly transitioning their assets. So there are hundreds of hotels right now on their way back or in special servicing, and basically the servicers are running them through receiverships that were consensually appointed, so that the borrowers can step out and step aside, which basically means the funding has to happen by the master servicers.
Mm-hmm.
Hey Keith, if Moody's just published this, so there's no reason for us to speculate. When you look at the different property types, office July 2020 versus July 2019 is essentially flat on delinquency. Multifamily is less, if you can believe it, July 2020 versus July 19. Industrial, everyone knows industrial is the winner here. 75% of all of the special servicing transfer loans are retail and lodging. That's where the problem is. The repricing that Debra's talking about in office, I think that is going to happen. So Victor Kalanog at Reese is talking about increasing office vacancies all the way through 2022, higher than their previous peak in 91. But it hasn't happened yet.
Right. So right now it's with retail and hotels. And when you're in conversation with these servicers, I mean, what's going on there? I know there's some concern as to whether they have the resources and staffing to be able to handle these requests. Are they able to handle all these requests? I mean, obviously nothing like this has ever happened. How are they dealing with this?
Yeah, I think their portfolio has basically doubled in 6 months from where it was at year end in 2019. And most of 2019 was CMBS issued prior to 2010. So a lot of old deals that have been in the market for a long time. They're all still working from home, working remotely. So they're doing, you know, their response, and part of their working remote, at least for the few that I've talked to, they're responsible for their own internet, dial-up technology, everything. Like none of the tech support that you would have if you were in the office is available to them. So they're dialing in, working and having to do it from home just like the rest of America. So it's quite a challenge.
So this could go on for a really long time, basically, as a result of that.
Pardon me?
Like this process could go on for a really long time as a result of some of these just day-to-day challenges with
yeah, because also their companies aren't saying we're coming back to work. I mean, their companies are basically announcing, these servicers and these larger banks are announcing we're going to stay remote through year end or through, you know, first quarter next year. They're starting to make those announcements to their staff. So,
but Keith, I think the special servicers are doing a decent job, but you have to make sure, because they have so many loans on their plate, when you do get that phone call back and it is your turn to step up to the plate, you actually know what you're talking about. You've done your homework, you have the data, and you don't, you know, I always tell the story of sometimes a real estate borrower that goes in and wants to buy a Mercedes and it's $100,000 list and they start at $2,000, right? If you start at $2,000 with the special servicer, you're going to get to the bottom of the pile. They're not going to take you seriously, and you may talk to their voicemail for another 3 months. So it's really, you know, the borrower has to take some of the responsibility when it's his turn or he or she's turn to talk, that they've done their homework and they understand what they're asking for.
So Rob, let me ask you this, kind of based off your conversations, how many of the borrower's claims, in your opinion, are legitimate or are worthy of getting?
Again, I think the people we deal with we don't take them as a client
Sure.
unless we think they have a legitimate ask. And we still may disagree with the special servicer, but if someone comes up to us and again, it's $100,000 and $2,000 and we can't get them off that bid ask, we won't take them as a client. We'll just say, here's 10 other phone numbers, call someone else.
Right, because, you know, to that point, I think, Keith, we've talked about this, right? There have been other situations where, you know, someone's made a headline about the fee that the servicer wanted to charge them to even engage in the forbearance. And when you peel back the story, you find out that that asset had, you know, a 10-to-1 debt coverage ratio going in, and that they're 25% leverage. That is a non-starter and a non-issue. Like, don't call the special servicer, don't waste their time, don't get in line in front of someone that actually needs relief, if that's your story.
So a lot of the properties maybe in special servicing now are ones that were struggling beforehand. Is that what you're seeing, or what, you know?
No, what I'm saying is if you were making 10 times more money than your loan payment last year, and now you want to call and ask for relief, don't do it.
Right.
Like,
Okay.
maybe give it another year or two and see where you are, but don't do it today, because it's a non-starter. As Rob was saying, the servicers are going to say, you paid us $1 and you made $10 after you paid us. Don't call me. Call me when there's a real problem, because there are 400 other comfort inn and suites that really need some help.
Right.
Or one of the bugaboos that I've heard from a bunch of our special servicers is you've got a sophisticated borrower that last year just did a refinance and took out a big chunk of equity from the deal, and immediately they're seeking relief. That's usually not going to be well received by either the master or the special servicer. But I want to emphasize what Bob was talking about. It's so important. When I talk to borrowers, even really sophisticated borrowers with very, very complex capital stack projects, it's surprising to me how frequently they don't even know whether they've got CMBS providing the senior debt on their property. They don't know where the trust is. They don't know who the servicers are. They don't know anything about the nature of the loan agreement that they signed. So you got to do your homework before you go in. There's no question about that.
Basically, is what you're saying.
Well, to get back to your opening salvo, there are just enormous structural differences between how a capital markets product like CMBS works versus going to your bank or your life insurance company lender. If you've got a problem on a bank loan or a life company loan, you pick up the phone, you talk to your golfing buddy, and they take it to committee, or they can make a unilateral decision. You'd better be prepared if you've got a request inside CMBS that differs from what you signed on the loan agreement. Better be prepared for a process, and you better understand who all the different participants are that are going to ultimately have to all agree in making a certain decision.
Right, that makes sense.
Well, and to speak to the loan side on the banking and the life co side, I mean, we have clients and relationships where the bank actually called the borrower and said, how are you doing? Do you need some relief? What's it look like? Like, they reached out, they were proactive. It's just a different mindset. The special servicer is not going to call you and ask how you're doing.
Right.
And honestly, Keith, it's such a crucial distinction. You really have to understand the different motivations. If you're a banker, the external pressure that you feel in dealing with a defaulted loan situation is felt most acutely in dealing with your regulator or your regulators. The bank regulators preemptively reached out to all 5,200 banks and said, all these institutions, you have our permission to enter into modifications, to delay payments if it's otherwise, in your estimation, prudent and reasonable. Mm-hmm. The way that CMBS operates is very, very different. The ultimate decision makers are the ones who are representing the interest of bondholders. Right. And the bondholders have to make sure that they're getting whatever recovery is possible, the recovery is maximized, and the losses are minimized. That's built into the contract that controls how the CMBS trust operate.
Right. And kind of going off that, I mean, I want to talk about the banks for a second. And we talked about, you know, how some of these borrowers are just handing over the keys to the lenders. And I've covered this in Florida. Are we going to start seeing this more? And how big of a concern is this? How worried are banks that maybe they're stuck with some of these properties that they weren't expecting maybe to take over? Debra, do you want to?
So the banks aren't really set up to own large portfolios of real estate. That's not how they make money. That's not where their business is, and that's not what they're supposed to do with the capital that they take in to redeploy for yield, right? So if the banks are taking it back versus making an adjustment to the loan, I think that we're going to see the banks be sellers, or actually let the sponsor sell it, in a short sell, if you will, because I think real estate sells better privately held than not privately held by a bank or something. I think it looks better to the market if the sponsor is, if it's sold by an actual third party. So I don't think that what we're going to do is see a whole bunch of real estate go back to the banks. I think that optionality real estate or optionality debt is more geared toward the CMBS market because of its non-recourse nature, and great proceeds, great yields. Right. And I think that we will see the transitions happen there over the next year.
What does that mean for the property? Go ahead.
Banks have a much different memory than CMBS too, right? If you default on a Fannie Freddie loan or you default on a Wells Fargo loan, you might not want to call up for the next loan, or you may be in the penalty box maybe for eternity. So borrowers are a little quicker to punt the keys to the CMBS trust than they are their, with or without recourse, than their local golfing buddy or their regional bank.
And there are some very large public company borrowers who are very, very clear about that. Simon Property Group has essentially said that when they want that optionality, they go to CMBS because they have no compunction at all about scanning their spreadsheet and saying that this particular mall is an underperforming mall, and we're going to give it back. We don't face recourse. We're going to make a purely economic decision. But Bob is right. You really can't do that with a relationship lender.
Right.
Yeah, what's really interesting is, and for a while this has been happening. So not just Simon, as you mentioned, Brian, but most of the public mall owners, right, when they report their mall holdings, they tell you if this is a loan if this is a mall that they're managing for the lender or that they're managing for their investors. They actually, some go as far as to call them lender malls in their reporting package. So it's clear.
Right. How does this play into, though, I guess, like the malls itself and these properties itself? Like, why, if a property goes into special servicing, why does it matter? What's going to be the impact to that hotel, that retail property? What is going to be the impact there?
On the broader market or the broader local economy?
Like for a local hotel, like say you go into special servicing, or I guess for the broader market, like, with all these properties going to special servicing, what does that mean for all these hotels than the property itself? I mean, is it going to change anything about how it's managed, about maybe, them doing renovations to the property, hiring new?
Probably not going to get better.
So, right. Okay. So it's just going to stay put, basically.
Listen, if you have four hotels on a corner, like on a highway in the middle of the country, and you have four hotels, and two of them are in default or in special servicing, and two of them are owned by owners, you may get cheaper nightly rates from the lender-controlled ones than you do from the borrower ones. But I don't know. I mean,
well, one of the workout strategies, or the forbearance strategies, particularly concerning lodging properties, is to essentially bleed reserves with the permission of the flag and with the permission of the lender. If you otherwise don't have any cash flow, you actually will go into all of your CapEx reserves and your property improvement budgets and essentially bleed the property short term. So if I'm going to that hotel, I'm going to notice that the sheets are a little more threadbare, and the carpeting isn't quite as pristine as it should be, and there'll probably need to be some kind of nightly rate adjustment.
Right. Gotcha. And then, as we're kind of looking at this now and looking at some of these issues that are going on with CMBS, what does this mean for the future of the CMBS market? I mean, is this going to mean that fewer borrowers are going to look to CMBS? I mean, how are borrowers now thinking about the future and thinking about looking at this as a means of financing their properties? And what do you guys think, Rob?
Borrowers are, at the end of the day, there's benefits and burdens for securitization, and the benefits are sometimes lower rate, more proceeds, and IO, right, and non-recourse. And as long as that exists, there will be a market, whether it's a $30 billion market or a $200 billion market, it depends. But if the CMBS market doesn't exist, there's a lot of property types that are not getting financed, right? So you'll have some values go down because you won't be able to finance some assets. So it'll be around. A lot of borrowers have short-term memories. And, listen, I don't know why CMBS borrowers think that somehow they have this, heads you win, tails I lose. Like, if you borrow $10 and your property is worth $50, you're only giving your lender $10. If it goes down to $2, they want their lender to, share dollar for dollar in the loss. And the lender has no obligation to take your phone call after you miss a payment. Right? They don't have to do a workout. They don't have to take your phone call. They don't have to do anything. They can just sit there and foreclose. So I don't know.
Well, one of the misimpressions, to the extent that there are a lot of borrowers listening in, this is a really important lesson, something that as an expert witness I've had to discuss with borrowers counsel and depositions before. There are some borrowers who actually think that the servicer is there to do the bidding of the borrower, that there's, heaven forbid, some kind of a fiduciary relationship or a caretaking relationship where the servicer has to protect the interest of the borrower. That is not correct.
Right.
The servicer is in a contract to protect the interest of the bondholders, and beyond that, the servicer is obligated to abide by the terms of the agreement, the contract that they sign, called the pooling and servicing agreement, to abide by the terms of the loan documents that have been signed by the borrower, and otherwise to comply with all prevailing laws. That's it.
Right.
Right. And the other thing is, and Brian, I'm sure you've had to speak to this before, right? Is the pooling and servicing agreement, the borrower is not a party to it. It is not your contract. It is not up for you to discuss or argue or, play. There's no card for it because your signature is not at the bottom.
Right. And you aren't a third-party beneficiary.
So now let me go the other side though. But there are some special servicers that are complete knuckleheads and literally have made decisions that have been so in like 50-point losses have turned to 90-point losses on deals and are 120% loss severities. Like, they rely on sometimes data that they know is 100% wrong to make decisions and to reject workout proposals. And then you just watch the asset get foreclosed and ultimately get sold at 30 points less than you offered, 2 or 4.
Why would they do that?
Here's why. Yeah, so having sat across the table from Rob.
I'll let Debra go first, and I'll give you my answer.
Yeah, I'll tell you, right? Because you and I have done this before, right? The thing is the servicer is making a decision based on what they have. Okay, whether or not you believe that they believe it's right or wrong, they are making the decision based on what they have. Markets change, assets change, right? It goes from being an asset where it's got plenty of reserves and free cash flow to an asset that doesn't have reserves and free cash flow. And 3 years later, it's a 90% loss. The point is, the hindsight look back does not exist. It does because there are rating agencies and people that remember and can look at it, but it's a hindsight look back, and that's not how they're measured. For whatever reason, they're not measured that way.
I say this to every special servicer, so I'm not afraid to say now, no special servicer is ever fired for being wrong.
That's true. That's absolutely true.
If you offer 80 cents on an asset and they say, screw off, we think it's worth 90, and they sell it for 50 cents, they still come into work, they still get their check. Like, it's only, so it's tough when you don't have, now they're going to argue, well, if we don't do a good job, no one's going to hire us. We're not going to get assignments. CCRs aren't going to hire us, but I don't know.
Well, let's talk about that for a second with the structure of servicers. I mean, it seems like they make more money the longer these things are in servicing. And they make, I mean, when they make more fees and stuff like that, I mean, what is that? I know that's some of the heat that they've come under. Is that accurate? And also, is that happening now? Are you seeing that now that maybe they're just trying to keep these things in there to make some more money?
I don't think anyone ever got rich in special servicing and retired.
I don't think.
I honestly don't. I mean, Rob?
I don't think anyone's pushing off a decision because they want to make another month of ticking fees.
Yeah.
There's also a payday when you resolve a loan in the form of a liquidation fee or a corrected mortgage loan fee, where you go from 25 basis points of accruing interest to 1 point. That's kind of one of the payoffs. So they're offsetting pressures to get something done as well.
Right. Okay. So there's no motivation to do that.
Mm-hmm. But I think
and notwithstanding what Bob said, I hear what he's saying, but I've been involved in a lot of litigation where special servicers have been accused of not doing the right thing at a loss to either junior participants out of the trust or even certificate holders. They can get sued. And now there's a new Dodd-Frank role called operating advisor we don't need to get into. But they're supposed to be looking over the shoulder of the special servicer to make sure that they're doing the right thing and following the net present value analysis about what the right resolution is.
They could get sued, and someday I could dunk a basketball. I get it. Yes, there's always, that's their argument all the time. I could get sued by a bondholder. Well,
right. Well, what kind of speaking of that, I mean, we just got a question, Rob, you answered it, about the influence the bondholders have in these decisions. I mean, right now, what are bondholders saying? I mean, what are they? Are they filing lawsuits? What's going on with the
pick a class? Pick a class. One of the interesting bits of alchemy about securitization generally, you're taking a pool of illiquid loans and you're turning them into liquid tradable bonds. If you're buying at the top of the structure, AAA, your incentives are different from if you're at the bottom of the structure, the B-piece investor that can control more directly the actions of the special servicer as a controlling class representative at the bottom of the structure.
Right.
So those classes are not monolithic. They have very, very different dynamics.
And different yields.
And different yields and different risk profiles.
Right, and different areas of expertise. I mean, the people investing at the top are just investing for a AAA bond, right? They're just diversifying their portfolio by investing in CMBS bonds. The investors at the bottom are looking for highly structured, high yield producing investments, and a lot of them are very experienced in credit underwriting and lending high yield dollars out. That's their job, to put money, high yield dollars to work. So, and that's just one area of diversification for their overall investment portfolio.
Right. I don't know any dumb B-piece investors. They are all very, very smart on real estate. Very, very smart.
Yeah. They become even smarter over the last, if you look at who was in the B-piece arena 10 years ago versus who's in today, it's a much more very, very diverse crowd, but extremely focused on real estate returns and markets. And they're investing across the capital stack in CMBS, as well as direct lending, LP partnerships, across the board. So they know what they're talking about.
Gotcha. Okay. And I guess for my last question, I just want to ask, like, what are you guys kind of looking at right now? Like, what should we, in the CMBS world, what are some things that you have your eye on right now? What's going to be the next steps to unfold? Debra, what are you kind of looking out for right now as to what could potentially unfold?
Yeah, so we're waiting, but we're watching and looking for, purchase opportunities through non-performing loans or other distressed real estate investments. We think it's early for that, but there's one or two that are showing up here and there. But I think hopefully by next year, we'll see some more activity whenever the servicers, the master servicers, start looking at their advance ratios on their portfolios.
Okay. Rob, what are you looking at right now?
We still have, we've never stopped having 30 to 50 workouts going since 2008.
Mm-hmm.
But we still kind of have that business, and that's kind of going along, and we're doing our debt brokerage on the side. So we're not like Debra, we're not looking to buy anything right now, or we just don't buy anything. We're purely advisors. So, I love for more decisions to be made and a little bit less kicking the can. But that's kind of what we're doing.
Right. Yeah. Brian, anything you're kind of looking out for, or anything that you're doing right now?
Yeah, just to pick up on what Bob is talking about, I think we're at the end of the beginning right now. So there has been can kicking because no one could figure out what was going to happen in the broader economy or at a given property. The real decisions that need to be made can be made once you transfer a loan to special servicing. The real workouts happen after you transfer to special servicing. What Debra had said earlier is that the industry has actually done a good job of doing something called performing loan consents, not requiring a transfer to special. Now the clock has kind of run out. So we're going to see some hardcore workouts happen.
Right. Is there anything else you guys are keeping your eye on? Like, I know there's bills floated around about relief for CMBS. Is that something you're kind of keeping your eye on, or do you have any? I don't know how big a deal is that to you guys?
Yeah, so the Hope Act, I think it's really interesting. Definitely, I can see how it's needed. My only concern is it doesn't let the market happen. It doesn't let market pricing happen. It's, if you bring in stimulus funds at, a 3% rate versus letting a yield investor come in and right size the asset, then my concern is we're delaying the inevitable.
Mm-hmm. What's inevitable? That they'll be foreclosed or
that there'll be price adjustments, because right now, even though things might be trading, we're seeing multifamily cap rates compress, at least here in Dallas. We're seeing, non-performing loans trading at par or close to par, or, in the high 90s. And so that doesn't seem, if it's a non-performing asset, it doesn't seem like it should be trading at par or close to par.
Gotcha. Brian, Rob, any thoughts of that? Or?
Well, what Debra's talking about is the entire world is stretching for any kind of yield imaginable right now, and buying a fixed income actually secured by a property in some ways continues to be attractive. I was just on a webcast conducted by Willie Walker earlier today. He just put Freddie Mac 10-year paper on a project at 213, a 213 coupon. These are crazy rates, but the 10-year T-note is also at 68 basis points. So of course, people are going to be looking anywhere they can for yield.
Yeah, but that's a subsidized market. Fannie, Freddie are government-controlled entities that are 100% subsidized, right? So
absolutely,
yeah,
absolutely.
So Rob,
it's still a crazy coupon.
It's crazy.
Yeah.
People should take all the money they can.
Yeah, no. If you can get that coupon, you should take it all day long. But Rob, speak to the non-subsidized market. Like, what do you think about those rates coming in, that equity coming in at 3%?
I don't think it lasts. I don't think equity is trying to make 3%. So I think your assumptions are wrong.
No, the government equity, government stimulus.
Government, like the hopes thing, it's stupid.
Yes.
They'll have so many strings, it won't get done. And then I haven't paid 1 minute of attention to it.
Okay.
I was just on the
It's going to
phone.
give someone a blank check and they're going to put preferred equity behind a CMBS loan. What about recognition agreements? I mean, who knows? I give that zero.
Zero hope for the
Zero hope from Rob Verrone. All right.
And if it does, like,
Zero hope, Rob. Yeah.
no, it's like the Fannie Mae forbearance. Everyone was talking about the Fannie Mae forbearance, the Fannie Mae forbearance. Not a lot of borrowers took it because it came with strings when you really went into it. You know, if you didn't pay Fannie, your Fannie Mae servicer and Fannie got a little upset if you took the forbearance. So again, there'll be some, if it does happen, there'll be a small subset that uses it, and some of it will help and some of it won't.
Gotcha. Well, all right, guys, I think that's all the questions I have. I appreciate your time so much. And if for anyone watching, if you want to continue to get this content and this type of information, please subscribe to The Real Deal. And thank you so much for watching. We'll see you next time.